Hello, I'm David Cassidy. This week, global equity markets extended the previous week's losses amid heightened coronavirus uncertainty. As you can see from the table, the US equity market suffered the biggest losses, with the S&P 500 index ending the week nearly 15% lower and the Dow Jones down over 17%. The Dow has now lost 35.12% since its peak on the 12th of February this year, and as a result has now reversed all of the gains it had made during Donald Trump's presidency. As the spread of coronavirus escalated, so did the countermeasures as governments and central banks around the world attempt to protect the global economy from the outbreak and the resulting lockdowns. For example, in the UK, the Bank of England restarted quantitative easing and made another emergency interest rate cut. Although it's disappointing that this week's positive moves by governments and the major central banks have not been able to reverse the extreme and cheap valuations which companies now trade at, the current disconnect between fundamentals, valuations and market prices is a positive for long-term investors, as the best time to invest is when others are suffering from disbelief and demoralisation. While we fully expect market volatility will remain elevated in the short term and are expecting to see evidence of economic damage continue to rise and company profitability to fall, we believe it is vital to resist the urge for any knee-jerk reactions and maintain a long-term perspective by looking past the negative news headlines and negative economic data releases, as equity markets have weathered and recovered from lots of negative and uncertain events in the past, and this time will not be any different. In fact, history is littered with periods where equity markets have fallen sharply for a couple of weeks or months, and market shocks always tend to be greater on the downside than the upside. For example, if we look at the stock market crash in October 1987, when the FTSE 100 index fell over 32%, or 10 years later in October 1997, when the FTSE 100 fell over 10% thanks to the Asian stock market crisis, while both of these were very scary at the time, which I remember well, having managed clients through them, they now look like small blips on a long-term chart. Equity markets hate uncertainty, and thanks to the scars from the global financial crisis in 2008-2009, equity markets have tended to react disproportionately to any uncertainty or disappointment. And unfortunately, this is one of those periods where panic and fear has gripped financial markets. However, we invest in a diversified selection of companies and funds that will survive periods of crisis such as this. While their prices have been impacted by an indiscriminate and emotionally driven sell-off, it may not actually require much good news for confidence and in turn higher share prices to return. The timing of a potential rally is of course difficult to predict, but we take a longer term view because evidence shows that time in the market is more important as it leads to better outcomes than trying to time the market. Looking ahead to this coming week, we should start to see a sense of the damage coronavirus is creating. Of most interest to us will be weekly US jobless claims on Thursday, the 26th of March, which could easily surge to well over 1 million from last week's reading of 281,000. Other key US data includes the Chicago Fed National Activity Report and the PCE, the Personal Consumption Expenditure Index, which is the Fed's preferred inflation measure. Elsewhere, we have Eurozone PMI and consumer confidence, and in the UK, CPMI, PMI, retail sales, and the Bank of England Monetary Policy Committee meeting.